Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. It's part 2 of our series, The Road Ahead, where we ask some of the smartest people we know about their insights, predictions, and what they're paying attention to. And we've got another awesome guest today on the Real Estate Guys radio program. Registration is now open for the Real Estate Guys 20th Annual Investors Summit. Imagine spending an entire week with like-minded investors, world-class educators, and real-world professionals. Returning in 2022, the editor of the Gold newsletter, Brian London, international real estate developer Beth Clifford, the author of The Creature from Jekyll Island, G. Edward Griffin, Jim Rohn's 18-year business partner, Kyle Wilson, and the rebel capitalist, George Gammon. And joining us live and in person for his 10th Investors Summit, best-selling author and the Rich Dad advisor for real estate, Ken McElroy. Plus, lots more to be announced. It all begins June 10th, 2022 in beautiful Belize. Visit realestateguysradio.com and click the tab that says Summit to reserve your spot. Go to realestateguysradio.com, click Summit, and make plans to spend a week with the Real Estate Guys, George Gammon, Ken McElroy, and an all-star faculty on the 20th Annual Investor Summit on Sand. Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. With me, as usual, it's our financial strategist and co-host, Russell Gray.
Hey, Robert.
We're in episode 2 of our series called The Road Ahead, taking a look at what's coming down the pike. And we've got a bunch of super smart people. Last week, Dr. Chris Martenson, and that was very illuminating. Chris has some very strong, very well-earned opinions about things. Today, we're going to hear from another opinionated gentleman who has made it his practice to really study this stuff. And he, like you, Russ, is kind of a layman turned economist, if you will. And that's our good friend, George Gammon.
Oh, yeah. So, George and I have a lot in common. We discovered that on our Investor Summit when we got a chance to really spend some time with him. And I kept saying, George, I feel like we're like brothers from another mother, or maybe even the same mother, except George is younger than I am. He's taller, more handsome, more articulate, and a heck of a lot smarter, but I've been at it longer. So it was fun getting into these really in-depth conversations about the plumbing of the financial system and what's going on. That's been a real personal area of study for me ever since the financial crisis, for reasons our listeners are probably well acquainted with. But George is absolutely brilliant. And George is a courageous guy like Chris and like the people we're talking to. They're looking at the facts, they're looking at the data, they are doing an analysis, they're thinking things through, and they're not afraid to say things that other people might be thinking and are afraid to say, or things that are so shocking that if you haven't started looking at this stuff, it actually challenges your sensibilities a little bit. Could this really be happening? And yet, if you think about some of the things that were conspiracy theories just 2 or 3 years ago with respect to things going on in the world, or if you go further back with our good friend G. Edward Griffin and The Creature from Jekyll Island, and you start looking at the way the world is working right now and what's going on and what's coming out, you have to begin to say, you know what, maybe there's more to this picture than I realize. And so when you're looking at the road ahead, it's important to get as many perspectives as you can. You don't have to like them all. You don't have to agree with them all. But if somebody's earned the right to have an opinion, and we're only putting people on the program that have earned the right to have an opinion, you may or may not agree with the opinion or the conclusions, but I think you're wise to take a listen. So I'm really looking forward to hearing what George has to say. He always brings it. Very smart guy, very articulate, and has become a good buddy.
One of the few people we've ever witnessed in our 8 years of attending the New Orleans Investment Conference that got a standing ovation this year. So he really knows how to put this stuff together and explain it in a way that if you listen long enough, you'll understand. And I only say that because I don't want your ears to gloss over as you hear some of the things that George is going to share today. He talks at a very high level. He knows his stuff very well. I will tell you, when we have him at live events, he's been to several of ours, he always takes the time to make sure the audience is getting it. He'll slow down, he'll repeat, he'll let people ask questions, but he also is very prolific when it comes to his podcasts and his YouTube channel. So he's used to talking at this level. This may be a show that you need to listen to more than once, but clear your mind and open your thoughts, because up next, you'll meet our friend George Gammon today on the Real Estate Guys radio program.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
When it comes to successful rental property investing, it pays to be picky. Pick the right markets, pick profitable properties, and pick great property management. That's easier said than done, but we've got great news. Terry Kerr and his rockstar team at Mid-South Homebuyers are going strong in Memphis, Tennessee, and Little Rock, Arkansas, too. So for a top-notch turnkey single-family home rental property, whether you're a new investor or have a large portfolio already, pick Terry Kerr and Mid-South for a truly A-plus investing experience. To learn more, send an email to midsouth@realestateguysradio.com. That's midsouth@realestateguysradio.com.
Don't be like Charlie, who scans the internet for IRA information, often getting bad information from copycats who have no idea what they're doing. You deserve to work with a reputable firm that specializes in one thing, the EQRP. Lucky for you, Congress just made it possible for you to get up to $200,000 out of your current 401k or TSP, so you can invest that money in real estate or even your own business. Even if you're still working, it's possible to get access to all this money tax-free. Whether you're a full-time investor, a doctor, or a government employee, even if you have employees, the EQRP is your secret weapon. You'll never see this strategy in Money Magazine, only here with the Real Estate Guys. Every major accounting firm in America is quietly sharing this strategy with their wealthy clients, helping them get their funds freed from 401k jail. Hi, I'm Damian Lupo, and we have your solution. With the CARES Act expiring soon, this strategy will be gone forever. The EQRP company is ready to help you unleash your retirement funds now. Want to learn more about this strategy? Send an email to eqrp@realestateguysradio.com for my special EQRP report today.
Hi, this is Kim Kiyosaki. I'm the author of Rich Woman, and you are listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program, heard every weekend on this great radio station all the time at realestateguysradio.com. We're starting our series of The Road Ahead. This is an interesting year already, lots to be watching. And a good friend of ours pays a lot of attention and a lot of time sharing ideas. Let's welcome back to the Real Estate Guys radio show, George Gammon. Hey, George.
Hi, guys. Thanks for having me back. Excited to be here.
Oh, my gosh. It's great to have you. I feel like I hear from you every day because I do talk about prolific in the podcast world. But, oh, my gosh, so much is happening right now. And as we're starting a new year, you know, you often say, how can it get any crazier? And then it does. Share with us, George, kind of the big picture stuff that you're keeping an eye on as we head into 2022.
Well, I'm paying attention to the Fed and the Fed's balance sheet first and foremost. So they talked about tapering back in, or started to taper back in November. And I was just kind of looking at a quick chart of the S&P 500. And since they announced and started doing the tapering, which is just reducing the size of quantitative easing. It's not like they're reducing the size of their balance sheet. It's just taking the amount of quantitative easing monthly purchases from 120 billion down to 70. I'm not sure where they are now, maybe 50, 30, something like that. The stock market is down significantly, and the NASDAQ is really, really down. So this really goes along with what we've seen since the GFC and the Fed started this quantitative easing program, which, by the way, was supposed to be temporary. Remember that?
Yep.
And I like to always remind people what our good friend Peter Schiff says, is that when they came out with quantitative easing, it wasn't quantitative easing 1.
Right.
They didn't number it because they weren't saying that we're going to do 2, 3, 4, 5 infinity. But that's exactly where we are now. So they're reducing that, or they're saying that they're going to reduce that down to 0. The market obviously does not like this. I think that was predictable because the market has really kind of been correlated to the Fed's balance sheet since they started doing quantitative easing. I don't think there's a direct causal relationship there other than just pure psychology. But the bottom line is when the Fed's balance sheet increases, the stock market goes up. And when the Fed's balance sheet decreases, or they're even hinting at decreasing, the stock market goes down. And that's extremely important now for the real economy, because in my view, the real economy is really predicated, it's really dependent, I guess is the right word, on asset prices, the stock market and the real estate market more specifically. So we've just in this tapering phase, and we see the market kind of getting upset. After the taper, according to the Fed, they're going to raise rates at least 3 times in 2022. So I think that could put further pressure, downward pressure on the stock market. And then during this interest rate hike, they're talking about doing quantitative tightening. Now, that is actually where they're going to decrease the size of their balance sheet. So they're going to be taking all these mortgage-backed securities, all these treasuries, and selling them back into the market, or just not rolling over the short-term treasuries that they have on their balance sheet. So this is going to be doing a couple things here. Number one, it's going to be reducing the amount of bank reserves that these big banks have in their accounts at the Fed. So the dollar bank reserves, these are assets of the commercial banking system, but they're liabilities on the Fed's balance sheet. So if you're reducing the size of that, a lot of people would say you're reducing the cash in the system. And why that's important is because when we get to the repo market, and I'm sure you guys have talked about that on your channel a bit here and there, but your viewers most likely remember back to September of 2019 when we had the repo blow up. And this is where interest rates in the repo market went up to 10%. And this was a huge deal. This is the dollar funding market. This is the plumbing of the financial system. So by the way, the global financial system. So if the repo market blows up, the entire global economy blows up. That's really the bottom line, because all interest rates would kind of levitate up to a level that was close to what they were in repo. Even the Fed funds rate, the overnight rate that the Fed is supposed to have 100% control of. In September of 2019, they lost control of that rate. Their target range was 2% to 2.25%, and it went up to 2.3%. So that they lost control by 5 basis points. And that might not sound like a big deal, but as far as market confidence, that is absolutely huge. And the Fed had to step in and do what they could to provide the liquidity needed to bring those rates back down. That's in kind of the mainstream view. There's other views, but we won't get into that right now. But the bottom line is, if the Fed does quantitative tightening, they're going to be reducing the amount of bank reserves available, the liquidity. They're going to be reducing the balance sheet capacity for these big banks to lend into the repo market and provide that dollar liquidity that really makes the plumbing of the global financial system work. So we've really got to pay attention to that. I think that's something that's kind of off people's radar. They look at the rise in interest rates or quantitative tightening, and they get hyper focused around the stock market. And I think that is important, that's for sure. But I think an even bigger thing to look at is how that affects the repo market. Now, let's look at another thing that they're talking about doing, and that's raising interest rates. So if you think through what a treasury is, or a mortgage-backed security, it's basically a bond. So if the interest rate goes up, the price goes down.
Yep.
Well, let's look at the repo market. And if you've got that liquidity that we were talking about, that's all fine and dandy. But the other side of the transaction is the collateral that's being posted. So a repo transaction is basically a collateralized loan. It's just an overnight, 2 weeks, 30 days, something like that. So if we look at the treasuries and mortgage-backed security, these bonds are collateral. So to make things easy for everyone involved here, let's just think of, let's say you guys have a used car and you need to borrow $1,000 from me. And you're putting up that used car as collateral because we agree that the price of that used car is roughly $1,000. So you guys give me the car as collateral, I give you the $1,000, and then do a switch back the next day, and you pay me $10 or whatever as an interest rate for the transaction. Okay, well, what happens if the market now values your car at $500, but yet you still need the $1,000 of liquidity? Basically, that means that the market doesn't have enough collateral to function. Well, what would happen? The interest rates would go up again. So you've got, whether you believe that the repo spike we had in September of 2019 was a result of a lack of liquidity or a lack of cash, if you will, on the balance sheets of the big banks, or if you believe it was an issue of not enough collateral, what the Fed is doing going into 2022 is reducing the amount of collateral and reducing the amount of cash. So if we have a repo blow up, that's going to trigger a collapse in the stock market. And that's aside from the potential of a stock market collapse being created by quantitative tightening or by interest rates in and of themselves. So I think my main takeaway as far as what's an action, something actionable that the average investor can do. You know, I can't give specific investment advice. None of us can. But what I'm doing is I do want to make sure I've got some dry powder. I've got a little cash there on the sidelines, because although it is difficult because you do have a negative carry, I mean, we'll talk in a moment here about how the headline inflation CPI is 7%, which means that real inflation in the real economy is far higher than that. So you're losing purchasing power by that cash position.
Yeah.
But if you have that cash position to buy assets in the future, that cash could increase in purchasing power relative to stocks and or potentially real estate, although I'm far more skeptical about nominal prices going down in real estate. But if your intention with that dry powder is to buy stocks, you could be increasing your purchasing power significantly because of the downside risk in the market because of what we were just referring to, while at the same time you could be losing purchasing power of those dollars relative to groceries or used cars or rent, et cetera. So that's kind of what I'm looking at. Then you layer over top of that the CPI. And so, because I think the next question becomes, if the stock market crashes, what will the Fed do? And a lot of your viewers, rightfully so, would say, well, the Fed's just going to step in and drop rates back down to zero, and they're going to just reinstitute this policy of $120 billion a month in quantitative easing. George, this is kind of a nothing burger because we've seen this movie before and we know how it ends. The problem with that analysis is that every time the Fed has done that in the past, or the government has come in with what I would call the government put, and this is a massive fiscal deficit spending that we saw in 2020 to really prop up the stock market and prop up the economy in general. They've done this in an environment of disinflation. So that doesn't necessarily mean that prices are going down, but that means that prices are going up more slowly. So if we look at the interest rates going back to 1980, 81, when Volcker jacked them up to whatever it was, 18, 19%, we see that interest rates have gradually gone down ever since. And we've been in an environment of disinflation. You can get away with a lot of money printing in disinflation to prop up the stock market or prop up the economy. But you cannot get away with that money printing, to use that term very loosely, in an environment where the CPI, the headline CPI, is going from 6.8% to 7% to 7.5% to 8%, because then it really becomes a political question. And I think you're seeing that right now with many narratives in the United States. If this is on YouTube, I'll try to keep it YouTube friendly, but we've got the narrative around what we've been dealing with since March of 2020. I think most people know what I'm talking about, right? So we've seen the mainstream media do a complete 180 on this. Why? In my opinion, it's because they got a call from the administration, and the administration says, listen, this is a platform, these draconian measures, this is a platform we cannot win on in 2022. So we need to change the messaging, and we need to do it pronto. Because I think we can safely conclude that the politicians' number one priority is getting reelected. I always say there are no certainties, there are only probabilities. But one thing I know with 99.99999% certainty is that that's a politician's number one priority. So if we can assume that to be true, what's the number one thing they can do to not get reelected? It's to have consumer price inflation, and significant consumer price inflation like we've seen, where the average Joe and Jane can see it every single day when they're going to the gas pump, when they're paying their car insurance, when they're paying their rent, when they're buying their groceries. This is the way you don't get reelected. So it's going to put the administration into a very, very difficult position, and the Fed, where they've kind of painted themselves into the corner, where if their actions prompt a stock market crash, whether it's via interest rates, quantitative easing, or that being the catalyst to a repo blow up, then the Fed's going to come in and say, okay, what can we do to prop up the market? Government does the same thing, but then like, oh, wait a minute. Unfortunately, this time it's different, because if we do this, we're going to exacerbate inflation. If they exacerbate inflation, that means there's a lower probability of the administration or the politicians being reelected. So you can imagine this phone call between the Biden administration and Jerome Powell. If the stock market goes down by, let's say, 20% in a disorderly fashion, like we saw in March of 2020, well, they say, Jerome Powell, you've got to do something about this. He says, well, the only thing I can do is really quantitative. The only thing I can do is print more money, let's say. And the administration says, oh, no, you can't do that because that's going to create inflation. And if you create inflation, there's no way we're going to get reelected. And then Jerome Powell says, well, if I don't prop up the stock market, there's no way you're going to get reelected. So what do you want me to do? We're kind of damned if we do, damned if we don't. And I think that's when we most likely will move into an environment of price controls like we saw in the 1970s. I think that'll be the path of least resistance for the politicians because they know they can't do anything as far as printing money to prop up the stock market and the economy like they have in the past. So you can see them coming out and saying that they're going to take bold, aggressive action for the consumer, for the poor and middle class. And this price inflation that we're seeing, it's not because of government distortions and government intervention and all of these things that we've done because of this central planning and top-down approach to trying to micromanage the economy. Oh, no. It's because these greedy capitalists and these greedy entrepreneurs have just increased their rents or increased the prices at the grocery stores. And they're just trying to squeeze the last bit of blood out of the turnip as far as the profits by sticking it to the little guy. So we're going to stand up for the poor and middle class, and we're going to fight these greedy capitalists, and we're just going to pass a law that says they can't increase prices anymore. I mean, I could kind of write the speech, don't you think?
Well, it's such an interesting point because, inflation has been the invisible, insidious tax forever.
Yeah.
But when it goes along just at a, 1%, 2%, nobody notices until you wake up and say, look at the trajectory of the dollar over 100 years.
Yeah.
When did that happen? When did Starbucks, go up 25 cents? We don't notice. But to your point, what's happened in the last few months is people are noticing. Not only do you have the constraints from all the logistics concerns, but you have real inflation across the board. When we were together at the Investors Summit last June, we had Dr. Doug Duncan, the chief economist from Fannie Mae, and the big discussion was revolving around how transitory is it? And I don't think any of us at that time bought it as being transitory, but now they're off that narrative. It's clear that it's here, and it's clear that it's out of control. But the other side, and where I want to go with this, George, is as real estate investors, inflation isn't always the enemy when we're thinking about asset values. Okay, all my properties are up. Not really, right? But they're up and rents are up. And yet, if inflation is continuing, or if it doesn't, if it abates in some level, that's a win perhaps for the politicians. Real estate investors go, well, wait a minute. Now you overlay that with what you talked about in terms of interest rates. The fuel we use as real estate investors is money that we borrow. Interest rates go up. Meanwhile, the tapering, or at least the less of expansion is happening. That's not necessarily a great recipe for real estate investors.
Yes and no. It depends if you know what you're doing. If you know what you're doing, if you're a Kenny McElroy, as an example, it could be a very good environment because yes, I think real estate prices are extremely high. If you adjust for inflation, they're higher than they were in 2006. So if we were, in a bubble, so to speak, in 2006, we're definitely in a bubble now. But that doesn't mean that real estate is a bad investment.
Right.
It's just, I think if you go out there and pay cash for $1 million condo, that's a bad investment. If you go out there and buy a starter home in Tampa, Florida, let's say 3-bed, 2-bath, 1,200 square feet, good neighborhood, B neighborhood, good school district, something like that, and you buy that property with 30-year fixed rate debt and you got good property management, that could be a good investment in an inflationary environment.
Yeah.
Because now what you're doing is you've used that debt as an asset. And in fact, I've talked about that a lot lately over the last year or so, because everyone is trying to figure out, what do I do with my portfolio? And I said, this could be an option. Again, you got to realize you're playing with fire. But if you really know what you're doing and you can create housing at the entry level, I think your downside is far less risky because they cannot create any more supply of what you have because input prices for building has gone up to such a great degree that they can't build any more starter homes. And, they can't build any more apartment homes at less than, $250 a square foot, something like that. So if you can buy under that price point, then by definition, they cannot create more supply until the prices go up above and beyond what you paid. So then if we get this inflation that you're referring to, you're paying the debt back with cheaper dollars. So you're basically increasing your purchasing power. And the thought experiment I like to use there is try to imagine back in the 1980s or something like that, when we actually had a rational real estate market and far less central planning. Back then, as we all know, when you bought a house, most people said, okay, well, this house I'm buying, this is an asset on my balance sheet, but I've got to borrow to buy this house, and that's going to be the liability on my balance sheet. But I'm okay with that, because if I buy this, let's say rental property, I believe that it's going to appreciate at this amount, and I'm going to get this much cash flow. So therefore, I'm going to be increasing my purchasing power with that asset, that property, more than I'm going to be decreasing my purchasing power by paying back that loan with interest. But now I think it's the complete opposite.
Yep.
Now I think you've got to look at that property as the liability on your balance sheet and the debt as the asset. Right? Meaning that there is a good probability that you will lose purchasing power adjusted for inflation. And that's very key. We should circle back to that in a moment. But adjusted for inflation, you could lose purchasing power with the property you buy. But just like we saw the flip side of this in the 1980s, that's most people would say, okay, that's all right. I'm okay with that, because I'm going to be increasing my purchasing power even more by paying the debt back with cheaper dollars. I think that's the mindset that real estate investors need to have right now, understanding that they're playing with fire. You can't just go in and buy something off the MLS. You can't go in there and buy something if you really don't know what you're doing. If you don't know how to use debt to your advantage, I would say stay away. But if you're someone that's more sophisticated and has taken the time to either learn through experience or learn by watching a podcast like yours, then I think they could dip their toe in the water in the right markets. I would really stay away from markets like California, like New York, for obvious reasons. But if you're thinking about maybe some markets where the RV ratio, meaning the monthly rent to your cost basis ratio, might be better, like, maybe some areas of Florida, some areas of Texas, maybe Idaho, something like that, I think it could make sense.
Our guest today is the rebel capitalist George Gammon. We'll have more from George when we come back, and we'll play real estate trivia next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
Self-storage is an asset class that has stood the test of time. Going into the Great Recession of 2008, self-storage had the least negative impact of any of its commercial real estate peers, and it had explosive growth coming out of that time during the recovery. Fast forward to 2020, and you'll see that same pattern during some of the worst part of the pandemic. Hi, my name is Dave Zook, founder and CEO of The Real Asset Investor. Our operating partners are some of the best in the business, and we've had great success over the last decade buying mom and pop operated self-storage facilities and taking them to the next level by forcing value through increasing the square footage, adding climate controlled units, bringing in our professional management teams, and turning the project into an institutional target. We have self-storage investment opportunities available for accredited investors who are interested in investing in this space for cash flow, tax impact, and huge equity appreciation. Reach out to us today at self-storage@realestateguysradio.com.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
Hi, this is Sam Freshman, author of Principles of Real Estate Syndication, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Hey, if you want to check out an awesome real estate market, join me in beautiful Ambergris Caye, Belize. For 16 years, we've been taking investors to discover Belize, and you can join me the first weekend of April. All the details on the website at realestateguysradio.com under events. It's episode number 2 in our series, The Road Ahead. And before we get back to our interview with George Gammon, it's time to play Real Estate Trivia, your chance to win a prize by knowing today's real estate trivia question. In just a minute, I'll give you the question. Your job, give us the answer by sending an email to trivia@realestateguysradio.com, trivia@realestateguysradio.com. As soon as you hear the question and think you might know the answer, send your best guess, and the first one that gets it right gets a cool book called Persistence, Pivots, and Game Changers, Turning Challenges into Opportunities, a collection of great and insightful stories from cool folks, including our co-host Russell Gray. That can be yours if you know today's real estate trivia question. Last week of the program, we kicked off the Road Ahead series with Dr. Chris Martenson and asked this: the first post office in America opened in Boston, Massachusetts. What year was that? Well, it was all the way back in 1639. I wonder what a first-class stamp cost then. Here's our real estate trivia question for this week. In which U.S. state will you find the town of Tightwad? Yeah, Tightwad, that's a real town in America. Where is it? Which state? If you know or you want to guess, or maybe you live in Tightwad, send your best guess to trivia@realestateguysradio.com, trivia@realestateguysradio.com. You want to include your answer, your name, and your physical mailing address, because the first person that gets it right gets this great book, Persistence, Pivots, and Game Changers. That's today's real estate trivia question. We're talking with our friend George Gammon. Amazing stuff, George. Really appreciate it. You know, last week we learned that the Fed was soliciting input regarding the proposed central bank digital currency.
I saw that.
Which has happened in several countries already. More are in the R&D stages.
Yeah.
What are your thoughts, and what are you watching there?
Well, as far as the central bank digital currency, I think that this is the next step to take us closer to their vision of a socialist utopia. And I know it's kind of a stretch for most people. I mean, most people say, well, what's the big deal? The dollar's already digital, so who cares? But if you notice in this, I saw CNBC do a story on that. And CNBC rightfully points out that the big difference is instead of your dollars that you have right now being a liability of a commercial bank. So just to be clear, for your viewers who might not fully understand the banking system, if you have $100,000 in your checking account, that is your asset, but that's a liability of the bank. They're basically saying they owe you $100,000, which is ironic because a dollar is an IOU. So they're just saying they owe you IOUs, basically. But what happens if we have a central bank digital currency is most people in the economy, businesses, corporations, et cetera, would now have an account, a checking account, if you will, with the Federal Reserve. So their assets, their dollar assets, move from the commercial banking system's balance sheet onto the balance sheet of the Federal Reserve.
Yep.
So why is that a big deal? Well, number one, because the Fed has an infinite balance sheet.
Right.
And I know there's some debate around this, but I'm of the view that the Fed could easily have negative equity, and it wouldn't. Who cares? They all they do is just print bank reserves at a computer screen, and I don't think having negative equity would impact that in any way, shape, or form. So that means that they can issue credit or extend credit to whomever they want for whatever reason they want. They can also control the demand side of the equation, because I think the way they get the central bank digital currency is by having people download, let's say, the Fed app. That's what gives them the account at the Fed. They give them, let's say, the next round of stimulus checks if the stock market crashes again. Good example there. And so then the people get the $1,000 a month, they get the stimmy checks, or they get universal basic income. And the Fed says, okay, you've got this $2,000 a month, but we want to focus demand, because they're all Keynesian, so they're all thinking about aggregate demand. We want to focus aggregate demand more in, let's say, electronic vehicles, or away from meat, because we know eating meat has a significant carbon footprint. These are their words, not mine. And so what we want to do is we're going to give you this $2,000 a month, but you can't buy meat with it. You can only buy soy products or something.
GMO
like
soy product, yeah.
Yeah, you can only buy a Tesla or whatever it is, whatever political narrative they're trying to push. So they control, I think, the supply side of the equation because they can extend credit to whatever business they want to. In other words, they can not extend credit to any business as well. Who knows what that will be based on? Because if they can have an infinite balance sheet, negative equity, they don't care about a profit and loss. They don't care about getting paid back on the loan. They don't care about the interest rate. So they can give loans to people who might not be able to pay them back. So how are they determining who gets a loan and who doesn't? If not for a credit score, then maybe it's a social score. Maybe it's something like that. Maybe it's just based on, whichever way the political wind is blowing at the time. But do we get to that point? I don't know. But the central bank digital currency gives them the power to do that in the future if they choose. Now, another big deal is the central bank digital currency would have all the transactions going through the Fed.
Right.
So you got to think about it right now. Let's say we have 1,000 banks in the United States. Well, these 1,000 banks are processing all the transactions that we do as a society daily, right? So, billions, quite literally, of transactions daily are being processed by the commercial banks. So they have that data. They know where you are spending your money, who you're giving your money to, who you're taking money from, and how much and at what velocity. But this is relatively decentralized because there's so many different banks. Now, if all of us have an account with the Fed, then all that data would be centralized. So there would be one entity that would know every single transaction that was happening in the United States economy in real time. And I think that if you read kind of where, I don't want to use the term global elite because, I don't want to go down the conspiracy theorist path, but I use that term, and it's just usually to describe the people at the World Economic Forum, the IMF, the BIS, and whatnot. So if you read what they're saying, they're big fans of artificial intelligence, and I think that that could be great in the future. But I think what they'll most likely do is take that artificial intelligence, they'll layer it over the activity, the transactions that's being accumulated by the Fed and the central bank digital currency. And in their mind, I think that's how they could allocate resources even better than price discovery or price signals, the price mechanism that's thrown off by free market capitalism. These people are central planners. They're not saying that implicitly. They explicitly come out and believe that the global economy and domestic economies should be more centrally planned for stakeholder capitalism, for equity, for equality, whatever you want to call it, whatever buzzwords you want to use. Their problem there is they don't like free market capitalism because this is a decentralized approach. And so they look back on Russia, they look back at China, they look back at the communist experiments that have failed in the past. And one of the main reasons they failed economically was because they didn't have the data that entrepreneurs and capitalists receive from price signals. So they've got to figure out a way around that. And I think that the central bank digital currency, along with all the data that's being collected in artificial intelligence, could be their solution, to that quote unquote problem. And this helps them take control of the means of production, which would get us closer to that socialist utopia. Another thing that you see them doing that plays into the central bank digital currency and this whole push towards authoritarianism and central planning is this move towards corporatism. And this is basically how they say it. They want to increase the partnership of the public and private sector, right? We want a better private public sector partnership. This is just straight corporatism where they get special treatment from the government. People see this as capitalism. It's quite frankly the opposite of free market capitalism, free market being the key phrase there. And so, these corporations get a tremendous amount of power. They get them from the politicians. And then if let's call them the global elite, the IMF, if they can control the politicians and a lot of these mega corporations, and if we have regulations such as lockdowns that we saw in 2020 and 2021 across the globe, this disproportionately affects the small and mid-sized business negatively. So if you can just wipe out all the small and mid-sized businesses and consolidate all of the demand to these mega corporations, it's a lot easier to control or influence, let's say, 100 CEOs at mega corporations compared to millions and millions and millions of small and mid-sized businesses across the entire world. So, whether or not this is their intention or whether or not they're doing this intentionally, at the end of the day, I don't think it really matters because this is actually what's happening. So whether it's intentional or unintentional, this is the net result of the policies that have been taken, I would say, since 2008, but that have really impacted us since 2020.
You bet. And it's easy to use it as a case study to say, hey, in the lockdowns, there were businesses that were non-essential, shut down. Of course, as you mentioned, a lot of the small businesses, that's just, they have no choice. Oh, but wait, we'll give some stimulus. We'll have some PPP loans. So you can at least pay your employees, which is where most of the money was supposed to go. Meanwhile, totally different deals for the bigger corporations. So again, not to be all tinfoil hat, was this contrived? Was this the plan? Or was it just don't let a crisis go to waste? And here are some ways. The government in general oversteps in most places, right? The government is not designed to be the nanny state. That's not how our Constitution reads. That's not what the idea was originally. But you know how it is with power, little by little by little. And, we're pretty agnostic politically on this program. What we look at is the financial side, as you do. You watch the macroeconomics, and you have to, in order, the whole what's an investor to do. It's such interesting times. So if we take that, and part of that could be, the case study part, the trial balloon. Well, let's see just how bad it is. Let's see how they push back and where. And now they're going to adapt the game plan. Either that, or it's just all, making decisions in the heat of the moment to see where things might go.
Yeah, and people have to understand that even if I'm sure there's a lot of central planners out there that their intentions are good. I don't think Jerome Powell is doing anything nefarious. I don't think he's twirling his evil mustache when he's off camera. But these people are economists, and they see the world in a completely different way to you and I and your viewers and listeners. And to give you an example of what I'm referring to, I had dinner the other night with this person, a fantastic dinner, but this person was a PhD economist. And they actually teach now economics at some extremely well-known schools. And I sat there and talked to them. And the way they view the world is through equations. It's curves. It's economic curves, supply curves, demand curves, equations, graphs. So as an example, the people listening to this, the average Joe and Jane, if you asked them if the economy is better today than it was, or even the same overall compared to 2019, I would assume that 95% of them would say absolutely not.
Yep.
Not even close. I mean, the half the grocery store shelves are barren. What are you talking about?
Gas has doubled.
Yeah, it's not, we're not living through the Great Depression, but it's not as good as it was. I don't have access to as many goods and services as I did in 2019, and I'm definitely being squeezed by consumer price inflation, the supply shortages, et cetera, labor shortages. But to an economist, they don't see that. A trained economist says, oh, well, our GDP growth is back where it was, or nominal GDP is back where it was prior to 2020. Therefore, the economy has to be the exact same as it was. They're just looking at a curve, or I don't even know what they are because I've never read an economics textbook. But this is their worldview. It's equations, it's graphs, it's charts. It's not real world kind of common sense. So my point there is, if you go back to the central bank digital currency, through their eyes, well, this makes a ton of sense, because if we need to just increase aggregate demand, well, we can just crank that dial. It's so easy to do, where now it's very difficult. We've got to rely on the banking system to create more dollars circulating in the real economy by lending them into existence. And if we could just control all of that, then, oh my gosh, we would be able to just micromanage everything. So if inflation got a little bit too high, well, we could just go into your account and do a little bit of a bail-in. Or, another thing, if you look at MMT, their solution to inflation, consumer price inflation, is just by taking dollars out of the system by increasing taxes. Well, the reason that usually doesn't work is because you can't tax people 100%. At a certain point, they'll just not pay taxes. And that's why if you look at the tax receipts as a percentage of GDP, regardless of the highest nominal rate, it's still right around 18%. But if we banned cash and we all had an account at the Fed, well, then Lael Brainerd or Janet Yellen or any of these central planners, they could say, oh, shoot, we overshot on inflation. We didn't want it to go up to 7%. We only wanted it to go up to 6.8%. So now what we do is we just increase taxes just a small percentage point, and you don't even have to pay it. We'll just take it right out of your account. And then that's going to, in their minds, decrease the rate of inflation. You know, we had Omarova, who was Biden's pick for the comptroller, basically in charge of regulating the banks. She was in favor of a central bank digital currency because she wanted to go so far as to micromanage the stock market. So she says, okay, well, now the economy is so dependent upon the stock market, which I would agree. I agree on the problem. I don't agree on the solution. Yeah. That's where we really differ. But she says, well, let's just have a central bank digital currency and let's give the power to the Fed to not only control credit in the real economy, but to control credit in corporate America and the financial economy, and to control the equity prices. So if we think the stock market is getting a little bit too hot, well, the Fed can go in there and just sell stocks short and short the market to bring it back down. And if we think it's going a little bit too low, well, we can just go in there and turn that little dial, and we can buy shares of XYZ company, and we can make sure it's elevated to a point where our models are telling us that we're running at an optimal level. So if you see the world through models and equations, and this makes a lot of sense. Why would you not want this?
Right.
But if you look at the world through a standpoint of just common sense and history, and how this puts us on an unbelievably slippery slope towards authoritarianism and totalitarianism, you're like, no, that's the worst idea I have ever heard in my entire life. And that's really the difference between the two groups. And unfortunately, right now, the PhD economists and the politicians and the global elite are pretty much calling the shots.
Hey, if you are not already paying attention to George Gammon, you need to do that. He's got an awesome YouTube channel and a great podcast, and easy to find George these days. You're pretty prolific, man. Other day, I think you came out with 5 or 6 short podcasts in one day, because there's a lot going on.
Yeah, I try to do the George Gammon channel, which is really just kind of overview macroeconomic stuff and getting into the weeds with quantitative easing, the repo market, and a lot of the things that we just discussed, and a lot of whiteboard videos I do on the George Gammon channel. But the Rebel Capitalist channel is where I just crank out 3, 4, 5, sometimes even 7 videos a day, live streams, where I just talk about what's going on in the news. It's almost like a video version of Zero Hedge.
You know, it was last week on the show that Russ came back from Rebel Capitalist Live, and I was at the Goals Retreat, and those two things together, believe it or not, added up for this whole idea of preparing for the future. So we appreciate your thoughts today. The next Rebel Capitalist Live is coming up in June, and you'll be joining us for our 20th annual Investor Summit. Super excited about that.
Not as excited as I am. That Investor Summit last year was the best conference I've ever been to in my life, by far. It was so amazing. In fact, I'm going to take the Rebel Capitalist team, if it's okay with you guys, because I want them to learn from what you guys are doing for my live events.
We would be honored. All right, my friend. Well, keep up the good work. And again, if this was over your head in any way, shape, or form, George does an incredible job of breaking it down, making it understandable, and love the fact that you always relate it to the real world. So, George, great to see you. Thanks for today.
Thanks for having me, guys.
There's the Rebel Capitalist, George Gammon. More when we come back. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
Real Estate Guys listeners, are you tired of losing real estate deals due to financing issues? Have you had enough of waiting on banks, lenders, and investor groups to fund new projects? What if there were a way to eliminate all the hassle and invest in real estate on your own terms? I'm here to tell you there is. Patrick Donahoe here from Paradigm Life. I'm an Investopedia Top 100 Most Influential Financial Advisor, and I recently wrote a best-selling book about the financial strategy that changed my entire investment model, and the one that could change yours. To get a copy of my book for free, and learn how you can maximize your real estate portfolio by acting as your own bank, send an email to mybank@realestateguysradio.com. Don't make another real estate deal without reading my book first. Email mybank@realestateguysradio.com now to get your copy for free.
For thousands of years of human history, silver has been recognized as money. As the size and frequency of major financial crises grow, silver is attracting a lot of attention. To help better understand the what, why, and how of silver, watch the free 9-part series, Making Sense of Silver. Send your email request to silverseries@realestateguysradio.com. Whether you own silver now or you're wondering if it's too late, email silverseries@realestateguysradio.com.
Hey everybody, it's Ken McElroy and I'm on with the Real Estate Guys, and I'm very excited to be a guest and a speaker at the Investor Summit on the Sand in Belize coming up. If you haven't signed up, be sure to do so.
Welcome back to the Real Estate Guys radio program. Thanks so much for tuning into the show. Hey, if you ever wanted to do bigger deals using other people's money or invest side by side with sophisticated, experienced investors, then come on out to the Secrets of Successful Syndication. It happens the first weekend in March in Dallas, Texas. You get all the details on the website at realestateguysradio.com. Under events, it is the Road Ahead series, conversations with smart people, and boy, George Gammon is one of those.
Oh, absolutely. You know, the thing that I appreciate about him is he just understands the mechanics of the system.
Yeah.
He understands the relationship between the balance sheets between the public and private sector. He understands where the Fed parks money. He understands the impact of interest rates on the bond market, something that I spent a long time getting my mind around and understanding. And, you know, he also comes from a background of real estate investing. He read Rich Dad, Poor Dad, and he went out after he sold his company and retired from business and became a very active real estate investor. And, you know, anybody that's a serious real estate investor is going to use debt. And anybody that's going to be a serious user of debt has got to pay attention to the bond markets, which is the source of the money, and the pricing of the money, which is the interest rates that we depend on. And of course, when you begin going down that rabbit trail, you begin to understand the outsized impact the Fed has on the overall economy, including jobs, wages, and the interrelationship between their monetary policy, which is what the Federal Reserve sets, and the fiscal policy, which is what the government sets. And so the federal government and the Federal Reserve work kind of in tandem. They're not supposed to, right? The Fed is supposed to be completely independent. But the reality is they are somewhat political. And they have sometimes a desire to support a political agenda. And of course, there's a ton of pressure on them from the politicians. They get appointed by the politicians. They have to be affirmed or confirmed by the politicians. And so, you know, you just can't be completely independent when you can lose your job if you don't suck up to the people that decide whether you get the job or not. So, you know, it's complex. It's a lot like, you know, bringing it back to real estate. You got an appraiser gets hired by the mortgage person, and the appraiser's got a lot of motive to bring the deal in, yet they have a responsibility to make sure the value is accurate. And if the value is not there, you can't do the loan. In fact, that was such a problem that after Dodd-Frank in 2008 and the financial crisis, they changed the rules about the kind of relationship that the appraisers and the mortgage community could have. And so we have the same types of conflicts of interest happening at the highest level of the financial system. And you just have to be aware of all these dynamics if you really care about using debt, the price of the mortgages, and then the impact on real wages and employment, and whether your tenants are going to have jobs or can afford rent increases. Right now, we've got inflation happening at the highest level in 40 years, right? Maybe you don't feel that much. It's no big deal to you if gas is $1 a gallon more, if food is twice the price. But if you're living hand to mouth, if you're at the tenant level and you're spending 100% plus of your paycheck just to put a roof over your head and eat, I mean, at some point as a landlord, you're going to feel that impact. And so these are all things that are very, very important to pay attention to because we're in a very rapidly changing environment.
Big thanks to George Gammon for sharing his thoughts with us. And in the coming weeks, we've got a bunch more guests lined up. You're going to enjoy those interviews. Hey, if you want to hang out with George Gammon for a week, well, then get signed up for the 20th Annual Investor Summit on Sand. Happens in June in Ambergris Caye, Belize. You get all the details by sending an email to summit@realestateguysradio.com.
Yeah, it's going to be great. Last year, George came to our summit for the very first time, fell in love, but it overlapped his event. This year, he was thinking about doing his event where it was going to overlap our event. We talked about it. He's like, no, I want to be there the whole time. So George is coming for the entire time. And, if you really want to learn from a guy like George, you need to have the entire time. Just imagine sitting out by the beach talking to him, having dinner with him. It's only going to be about 250 people. So the ratio between faculty members and attendees is really strong. You're going to be able to get into a lot of great conversations. Plus, the caliber of people who come on this kind of event, there's a lot of unsung heroes that are absolutely brilliant people that you'd never find unless you put yourself in this kind of a room.
Get more details by sending an email to summit@realestateguysradio.com. This is heady stuff, but who knows what we're headed into. We'll continue our series on the road ahead next week. Until then, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors from attorney and Rich Dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.